Today, I want to delve into the highly anticipated development where AMC, the popular entertainment company, appears poised to initiate legal action against various brokers and trading platforms. This legal maneuver is rooted in allegations of stock manipulation, with the intended consequence of pressuring these entities to abandon their illicit activities that contribute to market squeezes. Additionally, a noteworthy aspect to explore involves Citadel and other market makers strategically relocating their synthetic short positions to offshore hedge funds in preparation for potential legal repercussions. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. The imminent lawsuit by AMC against brokers and trading platforms draws parallels with a recent analogous move executed by Mullen Automotive. This resemblance implies that if brokers found culpable of engaging in illegal activities leading to a Mullen squeeze are compelled to desist, AMC might indeed follow suit. The social media sphere buzzed as Mullen Automotive took to Twitter, formally announcing the initiation of a lawsuit against prominent stock brokerage firms including TD Ameritrade, Charles Schwab, National Financial Services, and several others. The lawsuit contends that these firms have been instrumental in perpetuating stock manipulation and engaging in illicit trading practices. David Michery, the CEO of Mullen Automotive, conveyed his deep-seated frustration at the apparent losses incurred by shareholders, attributing these losses in substantial part to what the company deems as unethical trading practices. The strategic legal maneuver undertaken by Mullen Automotive is widely regarded as astute and potentially groundbreaking. Given the constraints that even influential figures like Adam Aron face, namely, their lack of dominion over the entire financial landscape, coupled with the limitations exhibited by regulatory bodies such as the SEC and DTCC, the pursuit of legal action against brokerage firms emerges as a potentially potent avenue for rectifying stock manipulation and invoking a market squeeze. This tactical approach stands in contrast to the utilization of share intelligence to unearth telltale signs of synthetic shares. By opting to pursue a lawsuit that effectively demands an end to the perpetration of illicit activities, the opportunity arises for the judicial system to potentially facilitate the long-anticipated market squeeze, particularly if market makers find themselves implicated alongside the stock brokerage firms. Zooming in on the intricate details of the Mullen lawsuit, a conspicuous disparity becomes evident between the volume of Mullen shares reported by the DTCC and the figures reported by broker-dealers to Broadridge, a company specializing in the administration of materials related to shareholder meetings. This divergence in reported figures hints at the possibility that brokers and trading platforms have been artificially inflating the count of shareholders and shares, thereby potentially introducing the concept of synthetic shares into the equation. Remarkably, disparate reporting figures become particularly pronounced during distinct reporting intervals, signaling the presence of synthetic shares within the market. The lawsuit involving Mullen and its collaboration with Broadridge, a player in the management of shareholder-related materials, is positioned to meticulously identify and lay bare synthetic shares that appear to have evaded registration with the DTCC. The origin of these synthetic shares can be traced back to market makers leveraging exemptions. These synthetic shares subsequently change hands via brokers on various trading platforms, ultimately making their way into the portfolios of retail investors. However, the pursuit of legal action of this magnitude and consequence could potentially force brokers and trading platforms to halt their unlawful activities. Should this come to fruition, it could spell the cessation of the downward pressure linked to synthetic shorting, thereby paving the way for a resounding market squeeze, an event long awaited by certain segments of the investment community. A pertinent inquiry pertains to the suspicion that Adam Aron might be in cahoots with hedge funds, an assumption that is swiftly debunked upon close scrutiny of AMC's trajectory. An astute observer would note that if Aaron had indeed aligned his interests with short sellers, AMC would likely have succumbed to bankruptcy at a much earlier juncture. Instead, Aaron's steadfast and unwavering commitment to counteract short positions and drive AMC's value upward stands as a testament to his alignment with the interests of AMC's shareholders rather than colluding with short sellers. Shifting focus to the migration of synthetic shorts to offshore territories, a revealing narrative unfolds. Citadel, a prominent market maker, along with its counterparts, appears to be executing a calculated move to transfer their synthetic short positions to entities like Trollo's Capital Advisors, located in Puerto Rico, a jurisdiction known for its advantageous regulatory environment. This strategic shift likely stems from the desire to minimize exposure to jurisdictional constraints and regulatory oversight. This phenomenon gains further weight through revelations indicating that a substantial portion of synthetic shares, valued at an estimated $590 million, has already been transferred into the offshore entity. To amplify the significance of this legal endeavor, it's imperative to recognize the potential ripple effect it could trigger. The forthcoming lawsuit by AMC echoes the precedents set by Mullen Automotive, hinting at a broader trend where companies seek to address stock manipulation through legal channels. By holding brokers and trading platforms accountable for their actions, AMC's move serves to safeguard the interests of shareholders while simultaneously addressing the broader issue of stock manipulation. Furthermore, the offshore migration of synthetic shorts introduces a strategic dimension to market makers' responses to potential legal repercussions. The adaptive actions of market makers like Citadel indicate their recognition of the evolving regulatory landscape. In the grand tapestry of the financial world, these unfolding events hold the promise of reshaping the dynamics of stock manipulation, market squeezes, and the regulatory oversight of brokerage activities. The outcomes of these legal actions and strategic shifts remain tantalizingly uncertain, injecting an element of anticipation and speculation into the world of finance. As the saga continues to unfold, stakeholders and observers alike eagerly await the transformational impact these actions could have on the future landscape of the financial markets. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.